Hey, good morning, everyone. Marty Missouri here, Monday, November 8th, 2021. This actually is your morning note. Unfortunately, I injured my right hand over the weekend and it's all taped up, and typing is a chore and really, really slow. So I thought I'd just give you a quick update here on the video. I'm not going to be able to draw any lines, but a couple of things I just want to touch on, then I'll do the usual. This is the U.S. Treasury 10-year index. The 14.78 where it sits at this moment means 1.478% on the yield, and really interesting Friday. So as you may recall, Friday we had a really good jobs number, supported the idea that the Fed needs to tighten monetary conditions, and they announced Wednesday that they're going to be tapering back their monthly bond purchases over the next few months and so on. So you might think that a robust jobs number would just send yields through the roof because that confirms that this economy is heating up. But that's not what happened. You see my arrow here. It actually went down, notably on Friday. Spiked up a little bit before the day today and just kind of bouncing around this morning. This is a delayed chart, by the way, 15 minutes. And we're half hour into the morning session. So what would that be about? Well, it's interesting because if you go back and you look at the history of quantitative easing, which is what these monthly bond purchases is called, typically when a QE program is announced, yields actually begin to rise, even on a trend basis while it's going on. And when the ending of QE or the cutting back of QE is announced, then bond yields begin to fall. And again, why would that be maybe not intuitive? Well, because during QE, they're also suppressing interest rates down to the floor as well. Well, the most logical explanation is that the quantitative easing is considered to be stimulative of the economy. So it is what would be considered an expansionary policy. A tightening or a pulling back of liquidity to the markets, to the economy, would be considered contractionary or an economy slowing policy. And when the economy is expanding, interest rates tend to rise, and when the economy is slowing, they tend to fall. Now, there's also an alternate theory that a real good macro analyst, I try to read his stuff when I can, he proffered this over the weekend, and he suggested that it's because Lael Brainerd, who is on the Federal Reserve Board, visited the White House the same day Jerome Powell did. And it's believed that if Powell does not keep his job, if President Biden does not reappoint him, that Lael Brainerd will get the nod. And she is considered even more dovish than Powell. In fact, she has uttered the three words yield curve control in the not too distant past as a feasible way to handle these circumstances that we find ourselves in. I've written quite a bit about that over the last year or so. That's my take, that the Fed has backed itself into the proverbial corner, and we have what some consider, and I'm sympathetic to, bubbles in both equity and credit. And the dollar cannot, for those reasons and for reasons that have to do with, trillions of dollars of dollar-denominated debt on foreign company balance sheets and so on, the dollar really can't rise on a trend basis to any consequential degree from here. So something in theory has to give, and that would be either the equity markets, the credit markets, or the dollar. And in my view, it would be the dollar. This is the impossible trinity that macro expert Julian Brigden has put forth that I agree with wholeheartedly at this point. Kind of looks like the 1940s scenario, different circumstances, but same kind of setup. Lots of debt, lots of deficit spending to come. That's a scenario where rising interest rates really, in theory, just can't be allowed. And back in the 40s, they instituted something called the yield curve control. Unlike quantitative easing, where you quantify the amount of money you print, in yield curve control, it's unlimited money to keep the bid under the bond market, the treasury market, to keep yields right where you want them. And they did that pretty much from 1942 to 1951. And by the way, they were able to inflate the economy at a rate faster than the debt. And we entered that period of yield curve control with 116%, I believe, debt to GDP. I believe came out of it with 80%, comfortably below 100%. And it trended lower even after they stopped the yield curve control strategy. So Lael Brainerd coming on, being dovish, you would argue, no, that's going to push rates higher, right? Because she's going to keep QE on forever, and she believes in modern monetary theory and all these things. But then the yield curve control scenario would suggest that she's going to promote that policy within the Fed. So, of course, time will tell, but really interesting setup, really interesting dynamic. Big thing still is the inflation debate. We've done that a lot, and we'll do it a lot more, I'm sure. Other big news over the weekend was passing of the infrastructure bill, and that you would think is market friendly. Here's your market update. Dow's up 148 points, which is 0.41%. NASDAQ Composite is up 0.14%. S&P 500 is up 0.12%. Russell 2000, that's small caps, is up 0.85%. The S&P 500 equal weight, which gives us a real feel for the breadth of the market, it's up just 0.09%. And then the NASDAQ 100 index, more concentrated than the NASDAQ Composite, it's actually down this morning 0.08%. For the commodities market, gold's up a little over 1/4%, 0.28%. Silver's up 79 basis points, that's 0.79%. Copper's up 0.94%, that's copper futures. WTI, West Texas Intermediate crude oil, is up 0.62%. And the ag complex is up 0.05%. So commodities catching overall a little bit of a bid so far this morning, and that's, as you know, that's a space we're in. And then the treasuries, 10-year treasury is down, yields up almost 2% this morning, so rates are definitely moving the other direction this morning. And the dollar is down almost 1/4%, going the opposite way of interest rates this morning. Okay, and as for our core mix in terms of what is in every client's portfolio, assuming it's large enough, MP Materials, a rare earth miner, is up 5.2%. AMD, chip maker, we added not that long ago, is up 3%, followed by uranium miners, oil, services companies, and metals miners and energy and Nokia and so forth. They usually give you the top and bottom 5. Ones in the red this morning, Viacom CBS is down a little over 1%. Utility stocks are down. That speaks to their negative correlation to interest rates. Consumer staples are down as well. Our Germany ETF is down, and Asia Pacific is down, just barely below 0. Overall, our core portfolio on the morning so far is up 0.41%. Tracking the averages pretty well, actually a little better than all of them except the Russell. But keep in mind, folks, that your portfolio, you clients out there, your portfolio is a global macro portfolio where we assess the entire world from a pretty high elevation and then allocate according to where we see the best risk-reward setups, and then hope to put together a portfolio that takes advantage of, what we'll say are the next, 3 to 5 year trends. And we think we have a lot of clarity there, given, again, when you think about central banks, the corner they put themselves into, and therefore the constraints that go with that. I will leave it there for this morning, and probably do this for the next, 2 or 3 days until I can actually type at a productive speed, but I'll try to keep them quick. Thank you as always for watching and listening. Talk to you soon. Bye-bye.